Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great. Well, hello, I'm Chris McAlpin with The Chase. And I hope that wherever you're going, whatever you're doing, that you're doing something cool, that you're building something great, that you're leaning in, that you're pushing hard. Or maybe you just need a rest. You need to catch your breath. And that's okay too. Know that we're here to help you. We want you to win. This show's about making money. And it's about investing. And investing in ways that doesn't hurt people and doesn't hurt the environment. It's also about the chase. That all-consuming drive that we all have for something good. The passion, the pursuit to win, to build, to be creative. But you must know that. All while you're chasing something good. The God Almighty, who loves you, is chasing you with something great. It's God who gives you that passion, that drive, that desire to win. He's the ultimate winner. And He's chasing you with something awesome. And I know, when somebody says something like that, you hear a red flag. They start popping up all over the place. But please, listen, we're here to educate. We're here to help people. We want to change lives. This is certainly not a ploy to use the Bible to sell people and becoming our clients. We look at the investment world through the lens of the Bible, which in our opinion, and I think I can make a very good argument for this, is the source of all truth. I'm an investment advisor. Our firm does financial planning, and we manage our clients' investment money for a fee. This is how we make a living. And we and our clients own some of the positions and use some of the methods that we discuss on this show. We're not giving personal investment advice. We can't do that on a podcast because we don't know you. We don't know your personal goals, your needs, your financial situation. In fact, you shouldn't take any financial advice from a podcast. Education, sure, but not advice. I believe that you should seek investment advice on the securities and the strategies in regards that we discuss on this show to see how they best fit you. Hey, we'd be happy to do that. We want to get to know you. But this show is for educational purposes only. The show's content is our opinion, and it's not an invitation to buy or sell any of these investments. We want to teach you what we've learned through experience, trial, error, gains, losses, and yes, losses. It's not always a popular idea, but losses are a part of life, just like risk. Last but not least, we're not perfect. We're not guaranteeing you positive returns. Past returns, research data, index history, all of those tools that we may use on this show, they don't guarantee future results. Sorry, I can't guarantee the future. That's the Almighty's territory. But we're going to look at God's truths about money, and we're going to look at some excellent ideas. I'm glad you've joined us today, so welcome. Let's get on with the show. Well, let me tell you a story. I'm sure that you've heard of the Franklin Templeton funds, but have you ever heard of John Templeton, or Sir John Templeton as he's known in the UK? Templeton is the Templeton of the Franklin Templeton Fund's name. So imagine this. It's 1939. Hitler and Germany are rolling over Europe. Mussolini and Italy have joined them. And Japan has been conquering the Far East for a decade and a half. And they show no sign of slowing down. The U.S. has been wrecked by the Great Depression. Our international trade is dictated by European powers. And the pound sterling is still the world reserve currency. Our military, if you look in historical notes, ranks like 18th in the world. We're pretty small, we're pretty weak, we're pretty isolationist. We're out of the way of this boiling war that's starting. And a 27-year-old John Templeton calls his broker and buys $100 worth of every New York Stock Exchange stock that's selling at $1 or below. Now imagine that for just a minute. 104 stocks, 37 of them were in bankruptcy. Hitler just invaded France, and Templeton is borrowing money to buy $100 of each of those stocks. All right, this is crazy insight or just plain crazy investing optimism, okay? And if you study Templeton, you realize he was not a warmongering profiteer. No, no one had ever seen a world war on the scale that the U.S. was about to see. In 1939, President Roosevelt was still promising the American people that we were not going to get into the war. But here was Templeton looking at the world and saying, if we get into a war, it's going to reinvigorate the U.S. economy in a way that no one could fathom. And that's exactly what happened. See, Templeton just looked at the world with a different lens. He just viewed it differently. This was the epitome of buying low and selling high. The story goes on to say that he took that $10,000 that he borrowed the stock and he 5X'd it over the next 5 years. By 1945, 1946, when he sold those positions, he had made a ton of money. 100 out of the 104 of them were profitable. And then in the 1950s, he looks at a wrecked Japan and he starts buying Japanese stocks at a PE of 3. I've never heard of this, okay? He's buying Hitachi. He's buying Fujifilms that went on to be huge names in the 70s and 80s with a PE of 3 in a country that was still hated by most Americans, especially most Americans in his generation. But he wasn't just an emerging market investor. He wasn't just an international investor, though he was known for that. He was without a doubt in his day the classic or the first well-known emerging market investor. Many investors still study him for this reason today. When we talk with Clint in a few minutes, this is exactly what we're going to talk about. But in the 80s, when everyone or a lot of investors were pivoting overseas, he was pivoting back to the U.S. Especially after 1987 and the stock market had crashed, he saw a lot of opportunity and started buying up stocks in 88 and 89. Again, he just looked at the world differently. In 1999, this is what was written about him. Templeton finished top of his class at Yale, was a Rhodes Scholar at Oxford. But a superb intellect is worth little in investing if you have the wrong temperament. Most investors, he says, most investors get led astray by emotions. They get excessively careless and optimistic when they have big profits. And they get too cautious and pessimistic when they have big losses. I've always worked on having more self-control. His secret? His unerring ability to stay calm as an investor is bolstered by his religious faith, which seems to free him from fears and doubts that paralyze others. Convinced he's a beloved child of God and that spiritual wealth is vastly more important than monetary wealth, he's never been rattled by the market plunges. Even when he took a beating, says Templeton, I never got depressed or despairing. I think of all the things that we can learn from John Templeton, that's probably the most important one. That in Christ, you can have an identity that success and failure neither make you arrogant nor crush you. And so when the markets are up and you're making money, great. We're doing a good job. We're making good money. Let's enjoy it. Let's be generous. Let's do the right things. When the markets are down and failure's crushing us, that's not really crushing us because it doesn't define us. There's this great verse I said often from 2 Timothy, that God has not given us a spirit of fear, but of love, power, and self-discipline. That means that at no time should investment returns cause you to despair. At no time should over-optimism cause arrogance. But that love and that power and that self-discipline, that we can go back to God and we can recognize the stability that He gives has nothing to do with investments and returns. And in that, because of that, then we can look at the world, we can look at emerging markets, we can look at international, we can look at domestic, we can look at stocks, bonds, ETFs, whatever the tool is that we're using, and we can learn to use them well. And we can learn to manage risk and stand on the gas and go make money or know exactly what we need to do at the right time. And so I hope that is something that sinks in deep with you, especially that verse about God not giving us a spirit of fear, but of love, power, and self-discipline. So here in the next few minutes, Clint Sorenson, good friend of mine, and I are going to nerd out on some emerging market topics. So stick around.
Founded in 2012 as an all-boys Christian school, Delta Streets Academy equips young men by providing Christ-centered, disciplined education. Delta Streets promotes the highest achievement in academics, a competitive athletic environment, and character development. The gospel of Jesus Christ is woven into all areas of the school, believing that glorifying God and serving Him is the foundation upon which all else is built. Delta Streets is becoming locally and regionally recognized as a school that provides the community with productive leaders. We encourage you to learn more about Delta Streets by going to deltastreetsacademy.org.
Well, today I'm having a conversation with one of my favorite investment geeks, Clint Sorenson. He is the chief investment strategist, he and his team, for Sound Financial. His firm that he co-founded is Wealthshield. They do outsourced chief investment officer work for other advisory firms. They build unique portfolios for those firms' clients. He's authored a number of books. He's authored a few white papers, and they do a lot of studies. He is a CFA and a CMT. He's very well read. I'm sure he's going to quote some of those books and white papers that he gets into. And really, before you think he's too much of a nerd, he used to do a lot of MMA fighting, which is one of my favorite topics to talk with him at times about. One of these days, you and I might need to go a few rounds, although you would whip my tail.
I wouldn't bet on it. You're a little bigger than me, and it's been a while, and I'm old now. I just turned 39, so that's a young man's sport.
That is a young man's sport. I'm older than you. It just hurts thinking about it. We'll arm wrestle. No, we'll thumb wrestle.
That's right, thumb wrestle, or we can play a game of chess or something. But
you'd beat me at chess, man. But I do love playing chess. All right, Clint, welcome.
Thank you.
Now, you and I get into some deep nerdy stuff. We're going to, at times, we get into some unique conversations on the phone or in our investment committee meetings. I think that our other committee members tend to tune us out when we get into those. I know that David and Joel tend to just press mute and they go off and do something else when you and I get in those conversations. But today we're going to jump into emerging markets. And then for our listeners, we're going to have a bigger conversation that Clint and I are going to record. We're going to make that available to everyone. And so, Clint, we get these questions from time to time. And we're going to roll on these topics, okay?
All right.
So what are emerging markets?
So emerging markets are markets of economies that are they're not quite developed yet, so they're growing. And that's where the term emerging comes from, right? So they're growing, their per capita GDP, so GDP per person, that's usually increasing. They usually have high growth rates, and they tend to be smaller countries, right? Countries that we wouldn't necessarily think about doing business in, right, or would be stable for business. So a lot of these emerging economies are just kind of rising on the scene. They're doing a lot of infrastructure, a lot of mining, a lot of activities like that. And they're starting early, right? You're getting in these markets early, which is kind of the notion. And so that's where the term comes from. And that's what emerging markets are. But now with the way indexes are built, right? The constituencies aren't always emerging economies, right? So in some emerging market indexes, you could have China, which, look, China's the second largest economy in the world now, and will most likely be the largest economy in the world in short order. And so when you start to consider that an emerging market, I don't know. I think the definition gets a little murky. So the way I define it is a fast-growing economy that's early stage, and you're getting in on the ground floor, no pun intended, as they continue to build their infrastructure, ramp up their education, work on property rights, and and hopefully they have a friendly government for business, and they're working on all those things. They're really improving those every day, and you get to make investments in a select few of these countries and the companies that are benefiting from the rise, and hopefully that yields good returns, right? That's the goal. Yeah.
So you said China. So that's the C of the BRICS. Okay. Are the BRICS still considered Brazil, Russia, India, China? Is that still the main four major emerging markets?
If you consider the indice, right, it would be Brazil, Russia, India, China. But I think you got to get a little deeper now. You got to look at areas like, Vietnam, right? Singapore. There are a lot of emerging economies. Emerging Asia is super attractive, where these economies are getting quite mature, actually. And they're good places to do business. When you look at comparisons like Europe or the US, right? They look like good places to do business from that perspective. And then you have frontier markets, which are a whole nother level of emerging markets. And those are areas primarily centered in Africa now, some in the Middle East, where these are, kind of the emerging of the emerging. And then you have the developed of the emerging, which is the BRICS that you mentioned. And then you have developed markets, which would be US, UK.
Explain those for a minute. Yeah, dive into developed so that we get a different kind of differentiate between emerging and developed.
Dive into developed. What are developed markets?
Yeah, so think about it from a growth rate perspective, right? So developed markets, the growth rate's kind of flattening out. We're not in this rapid growth phase that we experienced during periods where we were building out our infrastructure up, we were growing as an economy, and people were pouring in, right? Things like that. So that would be developed nations have flatter growth curves, and those would be things like, or countries like Europe, or the countries within Europe. It would be countries like the UK, right? The US. Those are all developed economies. I consider China a developed economy, but again, it is classified as an emerging market by many indices. South Korea would be another developed economy. Japan, developed economy. Australia, developed economy. And I've actually seen emerging markets that have South Korea in them as well. So right now it's by the index providers, typically classified as Europe, UK, US, Australia, and Japan. And then you have the emerging economies, the most mature of which would be China. And then you have India, which is still an emerging market, and it's rapidly growing. It's nowhere near developed state, and it's really attractive long-term from the growth rate perspective. Just the sheer number of people and the amount of growth that we can see out of that economy. And then you have Brazil and the Latin American countries who are all pretty much emerging at this state. And then you have some of the Middle East, and now you're getting frontier markets in Africa, which are the fastest, well, not necessarily the fastest growth rates, but they're the really immature emerging economies. So Africa, there's a ton of potential, right, for countries within Africa to really accelerate growth rates and to enter into that emerging space, but they're really small, so they're just not of that size yet.
So let's narrow this down, because we're getting kind of foundational on this. Why, economically, geopolitically, investment wise, why are they important?
Yeah, they're important.
Why don't we just invest in, Europe, Japan, Australia, the EFI plus US, and be done with it?
Yeah, because historically, the growth rate of an equity market correlates with the growth rate of the economy, right? At the end of the day, it comes down to just basic economics. You got to rewind a little bit and get outside of the era of money printing, which we've been in for quite some time now, where central banks just print money and you have asset prices rise because you're essentially debasing currency. But before those
pull you off of that soapbox.
Yeah.
We need to pull you off of that soapbox.
Yeah. But before those days, right, economic growth mattered. And equities materially increase their, at least historically, materially increase their growth rate if the growth rate of the economy was robust. And so investing in emerging economies is really attractive from that perspective. I almost think about it, if you're thinking about it from a company, it's like buying an early stage venture investment, right? Or a pre-IPO, right? That's really ramping up their growth rate. Their, the revenue growth is off the charts versus buying a blue chip, which would be like the developed economies.
Like a developed country like the US or UK.
Yeah, blue chip dividend growth name, right? You're still going to get some return, but there's potentially better economic return for the investor if they're going after those fast growers. And
sure. So in an emerging market, kind of like that startup company, you have a lot of times you still have governmental instability. You use the word frontier emerging market, but you do have some frontier-like Wild West criminal instability in a lot of these countries at times. It bleeds into their investment markets. So these are some of the risks that you have. You have boom and bust cycles that are severe. They don't have a central bank that can rein the economy in and rein the equity cycle in. Kind of like having a startup. You have a great visionary CEO that is a boneheaded idiot everywhere else in his life, but he can build a heck of a technology or a heck of a company, and you're betting on the future there. It feels a little bit like gambling, right? I hate using that comparison to investing, but when we're talking those frontier emerging markets, think United States in the 1880s, right? And think startup. I'm not going to use any names because then we'll have to do a whole bunch of disclaimers that we do or don't invest in any of those companies. But you go Google a few. You'll find some idiotic stories this year, right?
Yep.
So how do you invest in emerging markets?
Yeah. So just
follow up here. I'm just going to let you go on both these topics. How do you invest and how do you manage risk?
Yeah. So that's where I was going to start, right? Anything you're going to invest in, anything, the way you should approach it is through a risk management lens, right? That's that corrective lens that makes sure that whether your thesis is right or wrong, you're protecting your capital, right? That is, Warren Buffett's 2 rules. Rule number 1, don't lose money. Rule number 2, don't forget the first rule.
Rule number 1.
Yeah. Now, of course, you lose money occasionally, right? Values drop, but the goal is to not go to ruin. So don't go all in. Very simple things: diversify exposures, risk manage your positions, right? At the end of the day, when you take a position, know what you're risking, know your entry, know your exit, know how you're going to sell when it's profitable, know how you're going to sell when it's not profitable, right? Know your out point, and then know how to revisit these investments. Now, that's the broad speaking how. You got to get into investment vehicle discussions too, right? You mentioned a lot of the risks, so I'm not going to spend a lot of time on those because there's a ton of risk, right?
That's right.
Political regime, war. They don't have a central bank, meaning they don't have that. They have central banks, but they don't have a controlling central bank that controls the world's reserve currency like the U.S. benefits from, right?
Yeah, I mean, our central bank can crush an emerging market like that. And not even mean to.
That's right. Every historical instance of hyperinflation, and this was by a paper by GMO. They might have published it in 2012, but they published a white paper on hyperinflation. And what they found in their research was that there has never been a case of hyperinflation if that country borrowed in its own currency. Well, that's what the U.S. does. That's what we afford. That's why we're able to afford to print so much money without hyperinflation, because we have the world's reserve currency and all trade settled in the U.S. dollar, in particular commodity trade cross country, right? I'm
going to ask you about that later on. We need to dive into that in a bigger interview, because that's a lot of questions we're getting around that one.
Yes.
You were talking about vehicles in emerging markets. What vehicles do you use when we say, how can someone invest in emerging markets? A lot of times that question means, what vehicle should I use?
Yeah. So this is what I was getting at, is because of those big risks, right? Because they don't have the world's reserve currency. These countries can have hyperinflation, right? You've seen that, Argentina, Venezuela, Zimbabwe on the frontier market. You've seen these cases of hyperinflation. So there's a tremendous amount of risk that we don't necessarily have to deal with as U.S. investors. So the first order of business when you're investing in a vehicle, in my opinion, I think you look for active management here. I think this is one of the few places where there's still an edge to be had. And PMC, portfolio management consultants, they're owned by Invested, they did a report about what asset classes benefited from active management. And emerging markets were still one of them, right? Because if you have boots on the ground analysts and you have an edge and you have contacts within these governments, it's not as efficient, quote unquote. Another debate, another time, but not as efficient as maybe the U.S. large cap blue chip spaces, right? From an information flow perspective. So having active management, first order of business. Number 2, when you
get into random walk versus efficiency now.
Yeah. When you get into these active managers, you typically have to own them through a fund structure, whether it's a general partner, LP, limited partner type structure, like a hedge fund, which I would say that's awesome if you can do that. Or if you're just a typical investor, you don't want to put too much money at place in these countries, you might use a mutual fund. And the reason I like that is because you get ordinary shares. So ordinary shares are different from ADRs. ADRs are issues of stock that are held at a U.S. depository bank. So the universe is really small there. So if you're going to allocate to emerging markets, you're very limited if you're using ADRs. Which is what you're going to get if you buy like an SMA or want to buy those individual positions at your brokerage account. So I always like leading with the mutual fund with active management in that space, finding someone who has a definable edge, has boots on the ground in offices in these emerging economies, and is super focused on the fundamental work. And then I like using that as the vehicle, as a recommendation, but then managing the risk of that trade. So it diversifies within the emerging markets, within securities, but then I get to manage the allocation to that based on a risk management process, which is, again, catered to the individual investor. And we're not here to give out a rule set, but that's how I would do it, as far as it relates to investing in those type of markets.
And you make a good point when you bring that up, and that's something I should have said for the listeners as well. None of this that we're saying is direct investment advice. We're having a conversation. This is for educational purposes. So as much as we'd love to give you investment advice, a podcast isn't the place to do that. So, Clint, let's wrap this section up, buddy. We're going to get into a much longer interview with Clint. We're going to make that interview available to our listeners. You know, stick around for the next episode or the next segment of this particular show, because I'm going to dive into what the Bible actually says about international investment. And yes, it's in there. We're going to unpack one of the kings in the Old Testament's international trading empire. So stick around. I think you'll enjoy that. Thank you.
But God Ministries shares the love of Jesus Christ through building sustainable communities around the world. They're currently building 3 sustainable communities. The 2 Haitian communities are in Galets-Cambon and Toman, both east of Port-au-Prince, near the border of the Dominican Republic. The community in the Mississippi Delta is in Jonestown, which is located near Clarksdale. But God Ministries operates to build sustainable communities which provide spiritual and physical guidance, water, education, food and housing, as well as economic development, creating dozens of jobs. Learn more by going to butgodministries.com.
All right, so we've been talking about emerging markets today, and we're looking at different strategies, different ideas in investing, but I always like to come back and look through the Bible and say, okay, do we find support in the Bible for this idea? Or do we find something that's saying that don't try this idea, or this is sinful, or something like that, or just find no mention of it in the Bible? And depending on whether you find no mention, or if it's says sinful, there's a lot of different things that you can and should do. But when it comes to investing, we actually find a lot of evidence in the Bible of some instructions. Okay. Now, no, it doesn't tell you, go invest in the Dow, the ACWI, or the EFI. It doesn't tell us what indexes or investments to choose from. So don't ever think that. But it does give us some principles that we can apply and use. And in Ecclesiastes 11, I use this scripture a lot, but it says, send your grain across the sea, and in time it'll flow back to you. Now, as I said, I've used this a lot, but this particular verse, I think, points to Solomon's investments or trading empire. Of course, this is in 1000 BC, so he wasn't using an ETF or a futures trade, but there weren't those stock markets there, okay? So he was literally sending his money in the form of goods across the seas in trade. All right, so we can learn 2 important investment principles from this particular verse. Number 1, take a risk. It's the only way to earn a return. We're going to see in just a minute the way that King Solomon traded in the Mediterranean Sea and in the Indian Ocean, all across Europe, Asia, and Africa. But number 2, be patient. Investments take time. Profits made overnight can be lost overnight. And I think a lot of times, especially in the last year or so, we've seen so much money made in the markets when people got their stimulus checks and they piled them into the markets, and all of a sudden, the tech stocks or different names like GameStop or AMC, they really jumped, and people made fast, easy money. In fact, you see a lot of gambling podcasts that have now pivoted to stock market podcasts, giving us this idea of a sense of gambling in the markets and easy money. And I got to tell you, that is a recipe for disaster. And so take a risk, yes, but you got to be patient. You got to be wise. Solomon then goes on in verse 2 and he says this, but divide your investments among many places, for you do not know what risks might lie ahead. You got to manage risk. I say this often, but every investor that I read and I study talks about managing risks. And they just read a book, an old book written 100 years ago about Jesse Livermore, and he talked about cutting losses 100 years ago. And I've just finished another book where it's talking about investors just a few years ago, whether it's by Swagger or Covell, and they're interviewing investors, and they're all saying, number 1 rule, cut losses, manage risk, avoid ruin. Warren Buffett says that. Number 1 rule in investing, don't lose money. Number 2 rule, don't forget rule number 1. And so managing risk while you're taking risk is extremely important. But let's turn to 1 Kings. I think in 1 Kings in chapters 9 and 10, we can see a description of Solomon's empire. Since we're talking about emerging markets, we're talking about international investing, let's look at what King Solomon did. King Solomon also built a fleet of ships in Ezion Geber. a port near Elath. You know what? I'm not sure I said that name right, but just say it fast, say it confident. Sounds right, okay? In the land of Edom, along the shore of the Red Sea, Hiram sent an experienced crew of sailors to sail the ships with Solomon's men. They sailed to Ophir and brought back to Solomon some 16 tons of gold. The king had a fleet of trading ships of Tarshish and that sailed with Hiram's fleet. Once every 3 years, the ships returned loaded with gold, silver, ivory, apes, and peacocks. So King Solomon had a diverse portfolio, trading all over the Mediterranean, all over the Indian Oceans, all over Europe, Asia, and Africa. And one of the cool things about the promised land there where the nation of Israel, God's people, lived is that it had the king's highways ran straight through the middle of it. They were the land bridge for the three continents of Europe, Asia, and Africa. And so his empire that nation built, starting with King David through King Solomon and so on, was expanded through international trade. And so we see some of both the evidence and the instructions right here. So what can we really learn from this investment-wise? Because we got to kind of tie it into the year 2021. First, let go of your home biasness. All right? There's a big investment world out there full of opportunity. So look in that direction at the right times. We take risks, but we'd be patient. We see here that Solomon would wait 3 years to see if he was going to get a return on his investment. It wasn't like he got a monthly statement. It wasn't like he had an app on his phone to check his stock price to see if he was doing any good. No, the ship left the port and didn't come back for 3 years, or it didn't come back at all, period. All right? If his investments were successful or not, he had to learn to manage his risk. And he did that by diversifying. We see multiple places. We see land and sea trade, both in the Mediterranean, the Indian Ocean, the Gulf of Aqaba, North Africa, Asia, Europe. So we see diversity, and we see diversity in the actual investments themselves. But one last thing, this is very important before we close up. In chapter 11, I think it's great that chapter 11 is right there next to the chapters on his investments. This is what it says. When Solomon was old, his heart was not wholly devoted to the Lord his God. Solomon did what was evil in the sight of the Lord. And so now the Lord said to him, since you have not kept my covenant and have disobeyed my decrees, I will surely tear the kingdom away from you and give it to one of your servants. You see, in that time, Solomon had grown addicted to power, addicted to sex, addicted to money. And while we're not talking about power and sex today, we are talking about money. And I'm afraid that our society has grown addicted to gambling, to keeping score with games and numbers, and now money has seeped into that. And this isn't something that's happened overnight. This has happened over many generations in the U.S. But the lure of success, the lure of status, just seeping into every area of our society, I think it causes us to chase accomplishments without ever considering what those results are going to be. So when we succeed at that accomplishment, it doesn't satisfy us. So we chase more. And when we succeed at that one, it doesn't satisfy us. So we chase more. And when we fail at that one, oh gosh, that was the one that was going to satisfy us. And so it crushes us. And the truth is, that one was never going to satisfy you. You shouldn't have pinned your hopes on it. And we see this so often in money. And that's what this whole show is about, we're trying to educate people, trying to show people, beg you to not fall victim to that. Because while you are chasing success or security or status, God is chasing you with something far more awesome. I hope that makes sense. Take care. God bless.
Investment advisory services offered through Sound Financial Strategies Group, LLC, a registered investment advisor. Certain representatives of Sound Financial are also registered representatives offering securities through APW Capital, Inc., member FINRA, SIPC, at 100 Enterprise Drive, Suite 504, Rockaway, New Jersey, 07866, at 1-800-637-3211. Sound Financial and APW Capital are separate and unrelated companies.